What's up, guys? Mike Sharp here. This is Sharp Investing, not investment advice, just up front. I'm just a guy who does YouTube videos on the stocks that I own, buy, and look at. Do your own research. So flow traders, I've held flow traders for a few years now. It hasn't performed super great, but I think the business is performing quite well and have a good update on the new capital allocation program that they've employed this year. And I think we have some good progress and it gives us some good trajectory for the future. If you haven't heard of this company before, they are a market maker that is located in Europe. Most of their operation is in Europe, but they're expanding in the US and Asia. They already have offices in the US and Asia, but those are their growth markets basically, because they started in Europe and focus on ETPs, mostly ETFs kind of thing. And yeah, so if you don't know, watch some of the older videos. So Q3 was quite good, I think. Let's just go through the slides here. So on slide 3, we have net profit for the year, almost 100 million, looking pretty good there. Total income for the year, looking good on trading income, is up quite a bit from last year, up almost 100 million year to date to 320, and the EPS is 223 per share. So that looks like it's on track to hit about 3 euros per share this year. And I think that my take is that Q4 is going to be pretty decent too, because if you remember back to Q1, they with the launch of the Bitcoin ETF, which they're involved in making markets for those ETFs, they did quite well when the big wall of volume hit that market. And this quarter, as I'm recording this, Bitcoin's at like 98,000. And cryptos, unlike stocks, so stocks basically, flow trader will do well when the stocks fall because the volume goes up and the spreads blow out. But it actually works on the bullish side with these Bitcoin ETFs as well, because they're I think they're pretty low volume based on compared to the actual normally what they trade. So you can see pretty good run-ups in net trading income when Bitcoin sort of breaks out and the volumes go up, which is what's happened for the last since the Trump win. Okay, back onto the slides here. So setting up well for the year. If they do 3 euros, that's a 7 times earnings valuation right now, trading just over 21 euros. So not that expensive for a cash cow business that is growing. And as a reminder, if you're new, this stock does not, the valuations are weird with it because the earnings are unpredictable, right? And the market doesn't like unpredictability, but over time, they do make good money, right? You just don't know when it's coming because they need the VIX. They need the VIX high. They need some events that drive volatility and volumes up, right? And so, like I said, with Bitcoin. So if we go over here, look at the implied volatility last quarter. It was a little bit up. That was sort of an average long-term quarter, and it was driven by that August 5th crash in the markets due to the yen carry trade unwind. And they, some people think that the volatility is stifled by the powers that be. So that volatility event was very short-lived. I think it was less than a week, and everything was just back to normal going up. So that sort of dragged, even those 4 or 5 days dragged the VIX up by itself and dragged some profitability up for flow traders, I think. But if you look at here, really the tailwinds are there. You have this is the volume traded globally with ETPs, 11 billion. But you can see the assets under management; those are continuing to grow at a really quick pace. Like as you know, ETFs have become a big thing over the last 10 years, and expected to go to 25 trillion in the next 6 years, right? So basically a double in the next 6 years. So that market is still growing very fast, and that's a tailwind for them because they're focused on that. ETP velocity down. Let's not talk about that one. Again, here's the the fixed income, basically those volumes are going up over time as well. And so Flow Traders is moving more into the fixed income market. They used to just be European stock centric, and now they're in fixed income, cryptocurrencies, and basically anywhere there's volume they're growing into. So those are some of the growth avenues they have to exploit, and I'm sure they will over the next 5-10 years. But again, look at the Bitcoin volume and price. Boom, volume spikes on that spike up in earlier in the year with the ETFs. Oh, is that what that is? Yeah, that's what that is. ETFs come out here, and you can see the Q1 spike in the volumes here in the space. So I expect the Q4 is going to be up from last quarter. Last quarter is 87. That's a guess. I don't really have any way of verifying that, but that's my guess based on what I've watched. Regional performance. Now, I've heard this is a concern here. So you see in Europe, the volumes overall in Europe are up 21%, but Flow Traders for the year to date are up only, they're down 1%. Last quarter, they were up 26%, with the region's volumes up 37% year over year. So that would imply a contraction in market share. But what Flow Traders says is they're actually focusing on the most profitable segments there, not just volumes. So you can see that despite the sort of loss in market share, the actual profitability revenue statistics here are looking quite good, right? You have year over year up over 100%. Now, that part of that's VIX as well, not VIX, whatever the European VIX is, I forget what it's called, but volatility was higher, so that's in there. But I do believe them that they're focusing on the best opportunities they can have, because the issue historically with them is they don't have enough trading capital to exploit all the opportunities, so they have to pick some. So basically, they're trying to focus on the best opportunities while they build the trading capital. U.S., again, down here. I'm not sure if this is the same situation, because if you look at the profitability in the States, it was down. This is maybe a concerning area right here, but in terms of profitability, that one was a drag, so we'll have to keep an eye on that one. In Asia, this is going to be a huge growth market over the next 10 years. You can see the profitability is up almost 100%, and year to date up 43%. So this is starting to become a legitimate part of the business. Now, if you look back a few years, basically this is like almost zero. So this area of the business is growing pretty fast, and I think that's a quite a good sign. And I think last year they just opened their Shanghai office. Now they have offices in Singapore and elsewhere, but Shanghai opened, and I think that's a big opportunity to exploit. This one, let's just talk about this one quickly. So their operating expenses, basically this is a high operating leverage business. They don't need a lot of additional costs or capex to grow. So if you're looking at a high return on capital business, this is one to look at, right? The fixed operating expenses are actually down year over year as the company is sort of growing their footprint, and the full-time employees basically flat. So they're not even hiring right now, and you can sort of see that in the margins as they grow. What are we going to talk about here? Here's the margins versus the VIX kind of idea, right? So year to date, the VIX is down, but it's down from the last 4 years. But that's sort of average if you look long term. So I would say this is sort of an average year. Going to turn out about 3 euros per share. Now the margins, these are legitimately really strong margins. This is one of the reasons I love the business, because if you watch any of my videos, I talk about margins. I love margins. I don't think that, well, in this case, return on capital is a good metric to look at, but in a lot of cases, return on capital doesn't really show the strength of the business, and it's not really a good indicator. So if you have a high level of assets that you need in order to grow, then return on capital is a useful metric. But in something like a software company, IT, Meta, any advertising, like all that kind of stuff is not. The return is the return on the expenses that you have, right? The cost of growth is the expense, right? You're adding people in a lot of cases, and those don't show up in capital on the balance sheet, right? So in their case, like I just said, they don't need any more staff to grow. They really don't need any CapEx to grow. So again, this is just, how fast can they expand a footprint, right? But you can see EBITDA margins about 40% over time on average. This year to date, 42%. And I think usually EBITDA is a stupid metric, but in their case, it's pretty legitimate. Their interest cost is I think it's half $500,000 a quarter. And like I said, CapEx is almost negligible. And depreciation is, so CapEx is negligible. Therefore, depreciation is not a big issue because you're not replacing things over time. That's sort of upfront software expense that's being depreciated over time. So I would say this is pretty close to what you're looking at in terms of overall margins. I would say maybe it's more like 30, but the strength of the business is definitely there. You can see it. But like I said, their earnings are variable. The market hates this. You don't know what's coming next, right? 56 million or 600 million. But the other thing you'll notice is there are no negative years in here, right? So they make money in all markets, and I think that's continuing. I think that's actually going to be, I think their normalized years are going to be higher going forward, just based on the expansion of the footprint. So trading capital expansion plans. So here's the big one. So the big one for me is I said in one, maybe it was 2 videos ago, I said it was a plea to CEO Mike, and obviously he's not watching these videos, but they had a dividend policy where they pay a huge amount of dividends out based on their earnings. And I said, if you're able to get return on trading capital, look at these numbers, 50%, 60%, 90%. Like if you're able to get that type of return on your capital, why are you giving it to me? I can't get that kind of return. So basically it's, they're keeping it now. They cut the dividend and they're keeping the trading capital. There's a big crash in the stock price. But I think that was probably just all the dividend investors just jumping ship because they were on for the dividends. And now the shareholder base is transitioning to people who care about this capital expansion, which I think is good. You want long-term thinkers, and this is the kind of investor I am, because I think if you look at this through a 3 or 5 year window, it's gonna be quite good, because now all of this trading capital is compounding on itself. Before they'd make money and then pay a chunk of it out. Now it's starting to grow, and you can see quarter over quarter since they cut the dividend, essentially, that's up 7% quarter over quarter, right? So if we extrapolate that, just do simple math, 7% growth on capital for 4 years, you're going to see a pretty big growth in the capital base, which means they make more money pretty quickly, right? So return on shareholders' equity and return on equity, again, so this return on capital, I should say this is top line trading income, right? And then a percentage of that drops to the bottom line. So the return on equity is actually the better metric, I think. So the equity is sort of almost equivalent to the capital. See, the equity is 666, and the return on the trading capital is almost the same. So right now they're at 21% return on equity, and if you're a Buffett person, return on equity is a pretty important number. And this is one of the situations where return on equity is a legitimate metric to follow, because that capital compounds on itself, and then you're going to get 21% on the capital that they redeploy in the business, assuming they redeploy it as well. But again, it can go up and down. You can get huge returns in capital if you get volatility spikes, which we haven't seen since the first COVID year. So it's kind of like, even in low years, it's averaging probably around 20%, which is really good. So anyway, that's the idea. Those are the slides. Again, these are the mega trends that they talk about. I suggest you read into those if you're interested. But the ETP growth, like I said, the market, the pond they're fishing in is going to grow, is going to double pretty quickly. So I think that's the big one. Now, if we go to my, what do you want to call this, evaluation and projection, maybe I'll go through some of the numbers. So basically, I'm just showing how the trading capital can compound here. Right now you got 668 million, and that's growing 7% per quarter. I'm assuming another 5%, per quarter going forward based on EBITDA margin, return on equity, return on trading capital. I'm assuming return on trading capital is going to be 55%. That might be light, but let's say that's what it is. I think it's probably a fair projection. And EBITDA margin's 40%, even though historically it's been higher than that. So if you do that, the trading capital is gonna compound on itself 5% per quarter. And you can see it really starts to add up quick. If you project it another 3 years before, it's just going to do the exponential curve up, right? So in 1, 2, 3 and a bit years, you're going to see almost a double in trading capital. Down here, I've got total EBITDA for the year, 150 for this year, and then that might grow to about 260 in 3 years. If we put a fair multiple on it of 15 times, you're going to see, sorry, that's wrong. That's not one peg. You're going to see, well, I think that the company's worth more than 2 billion, right? And in 3 years, it could be worth almost 4 billion. Now, it may never get a margin a multiple of 14%, but if we put a cheap margin on it of 10 times, you kind of 15 times would be almost 50 euros a share, moving up to 86 euros a share. If you take a 10 multiple on that as opposed to 15, its fair value now is about 33 euros. Compare that to the 21 that it's trading at. Pretty easy math. In a few years, I think it's going to push up towards 60 euros, even on a crap valuation. Now, it's not going to be linear. I should be really clear about this. The earnings and the trading capital growth are not going to be linear. You're going to have really low VIX quarters like you've seen, and everyone's going to hate that and sell the stock. And then sometimes you'll have these big VIX quarters if we get any kind of dislocation, which I think is probably going to happen at least once or twice in the next 3 years. You can see earnings really go through the roof like they did in 2020, or a few quarters there with Russia invading Ukraine. All that kind of stuff destabilizes the market and is good for flow traders. So I think this is pretty safe. It's a business that's growing quickly. Like if I'm looking at just the trading capital increase here, go back to my slide. Trading capital is growing 24% per year. So that, for me, that's the business. That's the equity. That's their business base. And if that's growing at 24%, it's pretty hard to say this isn't very cheap right now, trading at 7 times forward 2024 earnings. Anyway, that's my take. I like that they don't have loss years, and I just have to wait for a good year basically to get paid, I think. So that's it for Flow Traders Update. And if you made it here, thanks so much. Hit like, all that stuff, or don't, and I'll catch you in the next video. Okay, one last little bonus add-on. I'm going to make one more plea to Flow Traders and the CEO, Mike K. I see that part of the expansion of trading capital plan is a term loan for, 25 million euros. I think that is a great path. And if I was CFO, or if I was suggesting something to do, I would say juice those loans. I would be going after 500 million in term loans, because the return on this capital is so high, assuming the interest rate is reasonable and that people are willing to, you have a willing lender. I would juice these returns, right? Adding 500 million of trading capital at the snap of a finger could really do well to speeding up this growth plan. Anyway, I'm sure you're not watching, but if on the off chance you are, that is my hope that you'll be doing that in the future. Thanks. Catch you in the next video, guys.